So this is the final panel for the day, and I'm glad that Mr. Vaswani could spare some time from his very busy schedule and come in. Thank you so much for joining us.
Thank you. Thank you for having me.
It's been one of those things that we wanted to do with you for a while, and Harsh and I have been talking about it beforehand. We're trying to analyze the tagline for the event, which is the blueprint for Viksit Bharat, right? The idea being that this country is headed towards a developed country, developed nation status in about 22 odd years. And obviously, banking is going to play a crucial part. Because Kotak is also a big business house with multiple other lines, all of which will help the entire country move forward to get closer to that. I want to first ask you and try and understand from you what you think is Viksit Bharat. To your mind, what is the developed nation? What can people look forward to?
So first of all, thank you. Thank you so much for for inviting me. Delighted to be here. I think, see, look, a developed nation has many characteristics. It's obviously economic, with a per capita income of a certain level, so that people have a good, sustainable kind of lifestyle. A developed nation also has, for example, a health system which is appropriate, an education system which is appropriate, opportunities to kind of do things more. Stability is another thing, and stability has many factors, including defense. And so a developed nation is one which you can rely upon to behave responsibly and play a role in the world economy.
So, sir, with that context in mind, if I can chime in, what is it that will be required of the banking system? Because banking as a whole, by its very definition, has seen a sea change. One in 2016 with demonetization, and thereafter in COVID, when everything started to go digital, and now digital is a very big part of banking. So therefore, what changes from here on?
So look, banking is the oil of the economy, and it facilitates payments, it facilitates trade, it facilitates investments, it facilitates capital markets, and it facilitates borrowing, and therefore banking has to kind of develop as the economy develops. Now, typically what happens is that the banking industry, the financial services industry normally grows at somewhere between 1.5 to 1.75 times GDP growth. And therefore, banking has to lead the way to kind of make it happen. And this has to be encouraged, taken care of, nurtured and developed. You talked only about COVID and demonetization because I'm older than you, much older than you. I remember the global financial crisis. I remember the internet, the dot-com boom, the Latin American crisis, the Asian crisis. And, so every 8-9 years, we've had something which is very substantial,
right,
and we've got to kind of guide our way through. Now, if you look at what the banking sector represents in developed markets, let's say like the United States of America, banking has led the way to that kind of development in all aspects of the market, whether that is, banking itself for payments and stuff, or trade, loans, capital markets, securities, and stuff like that. And as economies develop, what is going to happen is the balance sheets of banks are going to change. And the balance sheets of banks have to change because ultimately the kind of growth that is required in the economy cannot be supported purely by bank balance sheets. In developed markets, capital markets have to develop to provide alternative sources of funding for industrial growth. That in turn has to come where those capital markets reach out to banks, pension funds, insurance companies to be able to fund that kind of growth. Yeah. So the whole ecosystem has to develop. Another element of that is typically what happens is in a developed market, interest rates come a tad lower than in emerging markets. And as interest rates go down, again, the bank balance sheet changes quite dramatically, with things like mortgage loans taking a much higher proportion on the bank balance sheet. And different countries have evolved differently as far as mortgage loans are concerned. So, for example, in the US, they have bank or government-owned or virtually government-owned companies like Freddie and Fannie who kind of buy out standard mortgages to release the pressure on bank balance sheets. So elements like this will have to be considered and will come along as we move along. I think there's a third element to it. The third element to it is internationalization, right? A developed market is going to be an international market. And actually, I commend the way the Indian regulators have actually put us on a path of internationalization, which is so unique from any other part of the world, whether that's Latin America or whether that's Asia. The kind of route that we are going down towards internationalization is quite unique. And that will be another kind of thing which will develop, because foreign flows is obviously going to be a very important part.
You know, you mentioned banking alone can't spur the kind of growth that we need or the kind of growth that we should be looking forward to. Having said that, considering that they are large enough players in the debt capital market, at least a lot in equity as well, but largely in debt, right? How do you think banks can maybe then ensure that private companies and private enterprise in this country start spending? Because that is what will actually propel growth. Yes, the government can keep spending and personal consumption can drive balance sheets, but for the country to move forward, you need that private enterprise to start spending, to spend on capex. How do you think banks can help that?
So see, private sector capex is really a function of the opportunities that there are in the marketplace. At least in my view, private sector capex is not being restricted by availability of bank finance, right? It's about the opportunity in the marketplace. If you see the last 1 year in particular, we've had some kind of IPO fever. And frankly, that's been quite scary. If you kind of see the kind of companies that have kind of gone IPO. And it seems that a lot of promoters are looking to take money off the table, right? Now, is that a function of very high valuations? Is that a function that, you know, that the companies have grown? There's a next generation coming in which has different views. That, you know, we can kind of debate. So my point here is it's not the restricting factor for private sector capex is not banks. The restricting factor for private sector capex is promoters saying, hey, either my company has become so valuable, let me take money off the table, right? And I will now no longer run an operating company. It's too hard to run an operating company. I can make a very good return running a family office or investing. And therefore, those opportunities have to come back. Now, that may be a transitionary kind of period. There will be a new generation. You know, as I go around India and I see the startup scene in India, I get very excited. The youth of India today, you know, when I was growing up, if you got a job with a multinational, that was a great thing. After that, if you got a job with a great Indian company, that was a great thing. But today, all the youngsters want to go and do startups, which is fantastic. And those will scale and drive the kind of growth of this country. So maybe a transitionary period right now.
Interesting.
And so sir, as we grow in the next 22 years towards a developed nation, there will, of course, be plenty of banks who will stand up. How do you stand out in a highly competitive tech environment? Which are the banks which will really stand out in your view? What will be those characteristics which will help them stand out?
So look, technology is changing the world. That is not restricted to banking. In fact, I always say, two things. One, technology is no longer a vertical on an organization chart. It's actually a horizontal. And two, technology is too important to be left just to the technologist. And therefore, technology is changing banking, financial services, as it is changing every single other industry. Literally every single industry is changing. And frankly, if you look at it and you think about it, 25 years ago, even 20 years ago, if you were looking to build out a bank, you would naturally tend to getting a lot of people who had either done chartered accountancy or an MBA in finance. Today, If you look at the banks, like the new digital kind of banks, the kind of people you're looking for is engineers with computer science. That just says it all. What it therefore means is that banks today have to adopt a mindset of change, like in every other industry, frankly. But they have to adopt a mindset of change. That mindset of change is going to be getting people who understand this technology, or at least understand the art of the possible of the technology. If you can understand the art of the possible of technology and say, how is technology going to drive business, then things kind of fall into place. Fundamentally, all banking products and services are a means to an end rather than an end in itself, right? Nobody gets out of bed jumping or dying to get a mortgage. They want a home, right? No corporate treasurer is dying to get a loan. He wants to put up a plant. Right. And therefore, being able to be part of that journey, part of that home buying journey, part of that plant journey, and doing it in a way that is least obstructive to the end customer is what it's all about. And that's where technology will play its role. And the banks that will win will be those who do that the best.
Over the last year, I would say, this intense sort of race for the deposit, right? And it's become a bit of a joke where banks are saying that people will move their funds, they will chase returns, whatever. But then we have more or less stagnated on the deposit rate hike front, and still the deposits aren't coming. So I'm just trying to understand from you, how do you stand out? And is service, the quality of your service and the ease of your service, going to be that factor which sets you apart from your competitor?
So first, I'll give you multiple perspectives on this.
Sure.
Let's start at the macro level. At the macro level, even in a developed market like the United States, if you look at, let's say, what they call checking accounts, what we call current and savings. Checking account, the volume of current checking accounts as a percentage of GDP has actually stayed pretty much flat. This is despite that, 1 in every 2 households in the United States own some kind of mutual funds. So generally speaking, the level of money that lies in low-cost deposits remains pretty standard to GDP. It is not so much the quantum of deposits that's an issue. It is really the cost of the deposits that in the last 12, 18 months has really become an issue. Now, in our country, a lot of the liquidity in the system is really a function of government liquidity and government spending. So when government spending kind of slows down, like it did in, let's say, Q1 and Q2 of this fiscal year, you see a tight kind of situation. Then, of course, there was the issue with the rupee, which led to some further tightening of liquidity. But in our country, the function of government expenditure on liquidity is a big deal. Now, the government expenditure drives the economy, and therefore, nobody would be surprised that the government would try and spend more to drive the economy. So hopefully, liquidity improves as a result. And the RBI has already started taking action to kind of improve liquidity. So at the macro level, I think that is the kind of picture. At a micro level, look, banks will have to come up with innovative products that help customers and attract customers, right? So for example, at Kotak, we've got a product that's called Active Money. Now, Active Money basically says that we are going to trade off liquidity and return, right? So as long as you keep the money with us, we pay you a higher interest rate. You break it and bring it down, we pay you a lower interest rate. Customer wins, we win, everybody else kinds of win. What are the other kind of products, features, innovation, technology that can be used to actually develop new products that the customer is willing or the customer fancies that leads to deposit creation for the banks? And that's what we've got to kind of work at doing. And I'm sure all the banks, including us, are working very hard on that.
Right. Across the country, the diversity in the type of customer is very high. how do you appeal to every single one of them and ensure that the best quality in each cohort get tapped?
So, I always believe that the essence of strategy is denial, right? The essence of strategy is denial. It's not important. It is important to, of course, say what you're going to do, but it's more important to say what you're not going to do. Because you have to sharpen your focus. If you try and meet the needs, if you're going to try and say that everybody is my customer or is my target market, you're exactly for the reason that you mentioned, to your point, you're going to kind of miss it. Getting very sharp as to who is your target market, what are they really looking for, how can you define products and services for them, for who you're really looking at, will make you win. See, there is, again, my belief is that a lot of people think finance is all about Excel worksheets and 13.3% interest rate versus 13.1% interest rate and stuff like that. I would submit to you, finance is all about emotion. In fact, there's so much emotion that even sometimes couples don't talk about finance, right? Let alone you never talk about it to your friends and stuff like that. There's a lot of emotion and a lot of suppressed emotion in kind of finance. So it is ripe to actually to appeal to that emotional quotient to be able to get the customer. So if you're able to define who your customer is, who you're really going to go after, then you can get very sharp on who we go after. The good news is we have nearly 1.3 billion people. The ability to sharply define the focus on the customer is what I think will make you win.
I want to bring the focus around retail and the story there, right? The idea that retail is going to, or till now, was the steam engine behind which the entire banking system was putting its wagons. And then there was a very unceremonious stop. Then everybody started tightening things. Kotak, to your credit, the bank has remained sort of sane and static throughout this entire cycle. I wanted to get your view. Is the fear a little overblown at this point in time? That unsecured, yes, some people borrowed more than they should have, and they've had lifestyles which were entirely debt funded, and maybe that was not a pretty good idea. But is the overall fear a little overblown, or maybe there is still steam left in the engine to push retail forward?
So again, I'll start with the macro and
Sure.
then come down to the micro. See, on the macro level, even if you look at all the developed markets, consumer spending drives the economy, right? In the United States, about 60% of the GDP comes from consumer spending. That's true of the UK, that's true of Japan, and stuff like that. So as India moves towards a Viksit Bharat, the consumer driving the economy is definitely going to play a larger and larger role. Now that is again a macro kind of 50,000 feet kind of trend, which we will see. In between that trend, you're going to see none of these things is a straight line, right? They're always kind of bumps along the road. So what happened in this recent past? What happened in the recent past is during COVID, suddenly, the world and the banks froze. Nobody was prepared for an event like COVID. It was unprecedented, right? And in fact, unprecedented became such a cliched word in those 2 years that it was quite amazing. But nobody knew how to respond. Just literally nobody knew how to respond. And therefore, everybody froze and, banks got very, very, very cautious. In fact, a lot of banks raised capital, including ours, because we said we don't know how to manage this kind of downturn. Now, what happened to the consumer? The consumer, because they could not go out, because they couldn't see movies, they couldn't eat in restaurants and stuff like that, they froze too. So I don't know about you, but the savings rate during COVID went through the roof, right? So what's happened? The banks have kind of shrunk their balance sheets. Banks are sitting on a lot of capital. The banks are sitting on a lot of liquidity. The banks have actually not growing assets and therefore earnings are not growing. On the other hand, you have a consumer who's kind of got stuck at home, not traveled, not eaten out, not met friends and stuff like that. So the minute COVID opens up, guess what happens? There's something called vengeance travel. Everybody said, oh man, now we have to go on holiday, we have to meet, people who've got children living in different parts of the world, they hadn't met. So a lot of customer expenditure went through the roof. The bank said, frankly, nothing happened in COVID, right? Because excess cash was developed. By the way, the government pumped a lot of liquidity into the system, right? So the consumer was able to happily pay off all loans, reduce debt and stuff like that. So the bank said, wow, this is great. So now let's go and extend credit pretty extensively, right? And who do you extend credit extensively to? To the people who you think are, quote unquote, the safest, which is the salaried class. So therefore, that extension happened aggressively. Now, by the way, I was in the US and this happened exactly in the US as well.
Yeah.
I was running the UK at the same time. Identical happened there. Identical happened in India. So there was an overextension of credit that was done, and that overextension initially was all fine. And initially it was fine because the consumer had a lot of cash to kind of,
Cushion.
manage it.
Yeah.
Cushion. After that, that cushion ran out, so that led to some over-leveraging. And that led to a little bit of issues, right? Now, hopefully, I think, at least at Kotak, what we're seeing is credit card kind of stuff is stabilized. It's not deteriorating. But if you go down the chain a little bit, in microfinance, for example, you are still seeing a lot of pain. Same kind of issue around over-leveraging. But hopefully the banks have picked this up pretty quickly. Again, kudos to the Reserve Bank of India. If you remember, Reserve Bank of India actually came out and changed the risk weighting on unsecured assets. They picked up the trend pretty early and signaled to the banks that, you should have been careful. And I think that way we've kind of avoided a major issue. Now, touch wood, these things you have always got to be extremely careful. But as we sit now, hopefully, we've kind of managed through this.
There's a steam left. That was the final bit.
So it will come back, right? Okay. It will definitely come. See, these things are in cycles, right? These things are in cycles. It kind of, if you want to think about an anecdote, it's like a pig going through the python, right? It kind of goes right through, and then, the python starts moving again. And then you're kind of back to, all these things go in cycles.
Okay.
Okay. So for a brief couple of years, there was a sense that your fintech industry will actually be larger than the banks. They will actually start taking risk on their balance sheets because you have plenty of customers who are sitting there. That obviously was an overextension, a little bit of an over-exaggeration. I think we are now in an era where everyone's comfortably accepted that. But I want to understand, what piece of the pie do they take? Do banks continue to take the larger piece of the pie? Because they will take some piece of it, for sure. Just want to understand your perspective on maybe the next 5 years as things stabilize on both sides. What piece of the pie do they take? And what are banks going to do to actually up their tech game? Because that will be one of the big risks for the fintech industry.
So look, here's what happens, right? Why is a fintech able to kind of move quickly? Because they're usually speaking new, and they usually deploy contemporary technology, and they focus on a particular niche. And they go deep in the niche with contemporary technology, and they're able to move quickly. The banks, on the other hand, have a very, very, very wide beach, right? And therefore, they've got to deploy technology at scale. But the advantage that banks and stuff have is that they've got scale, right? So the fintechs have the ability and the advantage of nimbleness and agility. The banks have kind of scale. Now, the minute you start posing the question, is it banks versus fintechs? I think we're getting the wrong, I think we go down the wrong path.
Correct.
I think the fintechs need the banks because of the scale. Yes. The banks need the fintechs because of the kind of contemporary technology. And therefore, the happiest fintechs and the happiest banks are the ones who've built great partnerships, right? Also, the fintechs have to be very careful because, if they kind of grow balance sheets and accept deposits and stuff like that, they come under the regulatory net, which the regulatory net obviously adds a lot of responsibility upon them. So I think the best outcome is when you kind of partner. And you partner in certain niches, and where you really require that kind of cutting edge tech and the ability to move quickly is usually where a fintech will bring the greatest amount of value. But the banks will definitely step up their game as well. They're going to invest in technology. They're going to do a lot more, and they will kind of proceed as well. So, frenemies is the kind of term that I think about when I think about banks and fintechs.
But where will the profit pool lie? Just trying to get that kind of
So
perspective.
ultimately, the profit pool will always lie with the person who owns the customer, right? And therefore, direct engagement with the customer is what drives.
So things are not going to go out of bank hands for, anytime soon.
Well, I hope not.
All right, Mr. Vaswani, thank you so much for joining us on this conversation, sir.
Thank you.
It's
Thank
been
you
a pleasure
so much.
talking to you.
Appreciate it.
Thank you, sir.
All right, we'll take a